Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie here in London. These are the stories that set your agenda. Market caution as traders in Europe eye rate decisions from the Bank of England, the SNB and Norges Bank. Political uncertainty in France weighing on sentiment, with Macron pressured on both the right and the left. Mixed China activity shows a pickup in retail spending, but factory output cools and new home prices drop the most in almost a decade. The PBOC keeps rates unchanged. Plus, Ukraine's bid to garner support from the global south hits a wall as its summit in Switzerland fails to win over India, Brazil or South Africa. Let's check in on these markets. Then that political caution emanating, of course, from the risks around France remains front and centre, with Marine Le Pen trying to assuage the markets in a piece reported by Le Figaro over the weekend. But we watch, of course, sovereign debt of France and the broader picture around the equity movements. Given the losses we saw last week, the CAC 40 ending the week down more than 6%, the broader European equity space losing more than 2% last week, and diverging from the story in the US, with the gains of around 1.4% for the S&P by the end of that week. European futures now pointed to modest gains, 0.4%. Yes, big central bank week, of course, with the BOE front and centre for us on Thursday. FTSE 100 futures, speaking of the UK, pointing to gains of around 30 points. Interesting, given the pressure that's coming through on commodities so far in the session. S&P futures pointing lower by just 0.1%. Nasdaq futures currently essentially flat. Let's flip the board and look cross-asset then. We look at euro-dollar. We look, of course, as well at the commodity space. As I mentioned, the pressure coming through across the commodity space. Iron ore and Brent under pressure. Iron ore down, as you can see, a little over 2.4%. The real estate story, the property story in China, once again reminding us that crisis, that challenge is far from over. Iron ore then down 2.4%. Top of the list there in terms of the cross-asset board, 424 on the US 10-year. You did see a bit of a move in terms of the bond rally last week, largely on the back of softer data, whether it's the jobs data or the inflation story out of the US. Currently 424, yields up just 2 basis points so far in the session. 107 on euro-dollar, of course, given the pressures that came through for the single currency last week, following the most in at least a few months, of course, given the political pressures out of France. Brent, $82.34, down 0.3%. Let's get to the story in China then, because it's been a big day in terms of the data that's come through from the world's second largest economy. China's central bank leaving a key interest rate steady for a 10th straight month. This is mixed data out today, showed house prices falling and industrial production slowing in May, but retail spending did beat forecasts. Let's get more then in terms of the context and bring in Bloomberg's Jill Desis out of Hong Kong. Jill, it's a challenging set of data then, particularly for the property sector, and that's despite the push that came through from the government last month, a big package of support to try and put a floor under that sector.
Yes, Tom, I think you're right to focus on some of that housing data because, look, I know that, those retail sales figures were better than everybody thought, but you also have to remember that those came during a month, May, when there was a big week-long holiday, so that certainly boosted spending there a little bit. I think that's, what's driving that. It's really not a sustainable number that you're looking over month to month to month. So then I think that's what brings us right to these property statistics. You're seeing those home prices fall, pretty dramatically, I think worse since 2014 there. Telling us that, look, despite the fact that the government has actually rolled out quite a few, important property support measures recently, there's been some relaxation of mortgage rules in certain places. There's also been this big push to encourage local governments to buy unsold homes and kind of take care of this glut of, housing supply that exists in a lot of these areas. It's taken quite a long time for that to actually transmit through the economy and really sort of solve some of these issues here. I mean, Tom, we've been talking about this property crisis in China for years at this point. So despite the fact that we do have this big government support package, right now that's, starting to take effect, it does seem like it's going to take quite a long time before we actually see some kind of a meaningful turnaround there.
And meanwhile, Jill, the PBOC, the Central Bank of China, standing pat on rates. What for you does that tell us in terms of potential additional support that could come through from officials, from the powers that be in Beijing?
Well, Tom, I think that what it tells us about the rates picture in China is that the PBOC is still worried about too much downward pressure on the yuan, on the currency, and what that may mean, for the economy, and that it's really some of those FX concerns that may be trumping domestic concerns at this point in time. As you just said a little bit ago, it's now been, I think, 10 months straight that they've stood pat on this rate rather than ease more. I think that, likely officials are looking at what's happening elsewhere in the world. I mean, clearly the ECB rate cut just a few days ago wasn't enough to really trigger something from the PBOC. I think they might still be looking at what's happening in the U.S., what exactly that timeline on a Fed cut is going to actually look like there. So yes, I mean, really, when it comes to the PBOC, rate cuts just doesn't really seem like it's something that's in the cards yet. Maybe later this year, we'll have to see. But that's really what's pulling our attention to other forms of easing or other forms of support, like that property package that was revealed last month that we were just talking about earlier. Of course, I think some of the skepticism and the concerns around that, though, remain on what additional central bank funding might actually come to the picture to sort of really boost that and help the property sector.
OK, yeah, the policy response of Beijing and China constrained then by the Fed's continued, of course, insistence that rates need to be higher for longer. Jill Deeses, thank you very much indeed in terms of the China data. Let's get to the China politics then, the geopolitical story of the moment, which is around this visit to Australia. China's Premier and Australia's Prime Minister agreeing to strengthen cooperation and renew dialogue as the two nations' ties begin, at least on the edges, to improve. Li Qiang is making the first visit to Australia by a Chinese leader since 2017. Bloomberg's Paul Allen joins me from Canberra. Paul, what agreements then, thanks for joining us, have been reached so far?
Yeah, there have been a number of agreements that were signed this morning by Prime Minister Anthony Albanese and Li Qiang. A memorandum of understanding on strengthening the existing free trade agreement, on also working together again on climate change. There'll be a ministerial level meeting here in Australia on that between the two countries later this year as well. Also strengthening education, research cooperation, and Australia will now be part of the Chinese visa waiver program as well. So we've come a long way. And over the weekend also, Premier Li Qiang gifted 2 more pandas to Australia. The pandas that have been here will be taken back, having failed to breed, but 2 new ones have been gifted. Now, that may seem trivial, but as you know, Tom, from your time in China, this sort of thing is hugely symbolic. Panda diplomacy does mean a lot. You don't get pandas if you have bad relations. Also, Li Qiang visited a vineyard in South Australia, and it was only this year that the trade strikes on Australian wine were walked back. So we've come a very long way in a very short time when it comes to warming relations between the two countries again.
Yeah, the significance is certainly there, isn't it? So where does Premier Li Qiang head next then, Paul?
Well, he's still here in Canberra for just a little bit longer. He's meeting the Governor-General at the moment. Then he'll head over to meet the Leader of the Opposition, Peter Dutton. And somewhat significantly, Peter Dutton, for the first time today, overtook Anthony Albanese in the preferred Prime Minister stake. So that meeting took on perhaps a little bit of added significance. But the next stop from here, before he heads to Malaysia, is Perth. While there, he will visit a lithium mine. He'll also visit Fortescue Future Industries' hydrogen project. And critical minerals is, of course, an area that's of acute interest to China as well. China would like to increase its investment in critical minerals here in Australia, but from the Australian side, that is an area of some sensitivity. So challenges still do remain between the two countries. There are also these military-to-military near misses that have been occurring. Those were raised in the meeting this morning. And also the fate of the writer Yang Hengjun, the Chinese-Australian dual national. He remains in detention in China with a suspended death penalty. So while there's been a lot of progress today, there are still a lot of issues between the two countries to resolve. But as Anthony Albanese said, these issues can't be allowed to fester in silence. It's good that they're being at least talked about again.
Paul Allen in Canberra, thank you very much indeed on that visit by the Chinese Premier, the first one by a major leader, top leader of China, to Australia since 2017. Paul, thank you. Now, back to the central bank policy action. Days after the Federal Reserve pared back projections for rate cuts this year from 3 to 1 in the dot plots, Minneapolis Fed President Neil Kashkari says Fed policymakers need more evidence that proves stubborn inflation is well on its way to that 2% target before cutting rates.
We're in a very good position right now to take our time, get more inflation data, get more data on the economy, on the labor market before we have to make any decisions. So we're in a strong position. But if you just said there's going to be one cut, which is what the median indicated, that would likely be toward the end of the year.
OK, for more, let's bring in Bloomberg MLive strategist Mark Cranfield in Singapore. Mark, Neil Kashkari then saying that the Fed can take its time. He's not a voting member this year. That's important context as well. He says the Fed can take its time. What does that mean, in your view, for the greenback?
It must feel like deja vu for a lot of foreign exchange traders and probably bond traders as well. So last week, we particularly had that softish CPI data, which was taken very dovishly by the market, and then the Fed followed on from that. And already we're getting the Fed speakers pushing back on the idea that the market has interpreted it in the correct way. And there's a lot more Fed speakers to come this week. And we can expect pretty much more of the same. Generally, for the Fed guys to be saying that they need more time, they're in no hurry. And of course, that's going to be reasonably positive for the US dollar. And of course, it comes just after the Bank of Japan largely disappointed the market by not really coming up with anything that supports the Japanese yen. So the strength that we've had for some time in the US dollar doesn't look as though it's going to go away. The Fed speakers are helping to fuel more of that. And if you look on the flip side, you've got two of the most important currencies, the Japanese yen, Chinese yuan, as Jill was saying earlier, that's under pressure as well. Policy is not being changed in order to protect the yuan as well. So wherever you look from an FX trader's point of view, it's a familiar story where on the one hand, they see something that looks as though it could weaken the US dollar, and then the central bank speakers come along and they change the picture again. So it's going to be very data dependent from here. But certainly the main risk is that the US dollar strength we've seen does last for quite a bit longer in foreign exchange markets.
Yeah, with the challenges, as you say, from central banks like the PBOC and over in Japan as well, the BOJ. Currently, the Bloomberg Dollar Index just edging higher in the session. Look, we were all fascinated by what was happening in terms of French assets last week, whether it's the pressure on the equity market, the CAC 40 falling a little over 2% by the end of the week, or indeed the sell-off in French sovereign debt. Bond futures in France currently lower again in Asia. What is your expectation in terms of potential further turbulence? How much pricing has come into the French debt market at this point?
I think very specific French assets are probably going to retain that pressure for a while yet, particularly the bonds and the equities. Traders are obviously very concerned that we could get a pretty messy French election result, and maybe it's not fully priced in by now. But ironically, one of the assets which may change course a little bit this week is the euro-sterling exchange rate. A lot of foreign exchange traders were selling the euro against the pound on the expectation that the UK politics situation was going much clearer than the French. But that's beginning to unravel a little bit. If you look at some of the information that came out over the weekend, maybe we shouldn't be so complacent to think that the UK election is going to be a one-way bet. It might not be the case that we get a very clear-cut result, which has been the betting for some time. So maybe people need to dial back a bit. Assuming that the UK election is going to be very easy to call, maybe that's beginning to be a little bit too easy. That's too much priced into the pound. Also, leverage traders are pretty long of the pound as well, which is a sign they may need to cut back. And then if you look at the French, the news that's been coming out over the weekend in the polls there, maybe the French result is not going to be quite as damaging as initially thought. So certainly there's a chance for euro sterling to have a bit of a move this week, even if the pressure remains on French bonds and French equities.
That's really fascinating, particularly around the assumption on UK politics, given the polls that we keep seeing. Bloomberg MLive strategist, thank you, with that warning, of course, for the markets around the political risk. Mark, thank you. Coming up, Ukraine's bid to garner support from a number of key nations from the global south falls short. The latest on the summit out of Switzerland and the implications for support for that country going forward. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Ukraine's bid for support from the global south against Russia's invasion has faltered at its two-day summit in Switzerland. China avoided the event altogether. And you got a lack of support for Ukraine's position, particularly from the likes of South Africa, India and Brazil. Bloomberg's Oliver Crook joins me from Berlin with the details. Ollie, walk us through what happened at the Swiss summit. How much of a disappointment will this be, or not, for Zelensky?
Yeah, well, listen, Tom, it's sort of odd to even talk about peace summits at this stage in the war, right? Because we think about how deeply entrenched each of the two sides are in their positions and really very little sort of overlap. So what this summit is meant to do is sort of begin to start sort of devising languages and joint communiques about how to talk about, the possible paths for peace. And the idea here was to bring in, more than 100 countries together, get a sort of joint communique together. So they put out a communique at the end here. And it was really very broad. There wasn't a lot of details in terms of steps for peace. It was looking at basically nuclear energy and nuclear installations, making sure they're safe during the war. Global food supply was another sort of big theme. And then the third was sort of returning of prisoners of wars on both sides, but also children that had been taken from Ukraine into Russia. And again, these are sort of very broad principles. He doesn't even get into the nitty-gritty. And a number of countries were unable to sign up to this communique that we have here in front of us, right? So China was absent from the meeting, but we also have Saudi Arabia, India, Brazil, South Africa, all sort of refusing to sign up to this. And the Saudis saying that basically if there is going to be an end to this war, it is going to involve a lot of difficult compromise from Ukraine. And let's not forget, Tom, this also was a meeting that was being held in the shadow of these demands made by Vladimir Putin, his so-called sort of peace conditions for Ukraine, which basically amounts to surrendering the east of the country and basically withdrawing Ukraine's desire to join from NATO in writing, which of course is a total non-starter for Zelensky.
Yeah, I still find it fascinating that the South Africans will take Israel to the ICC, but won't call out Russia over its bloodletting in Ukraine. Meanwhile, after a week of intense global dialogue then with Ukraine at the centre, where does it leave the war in terms of what the situation is like on the ground, Ollie?
Yeah, Tom, I think it's a really interesting question because obviously, Zelensky began his sort of tour here in Berlin. He went to Saudi Arabia. He ended up at the G7 meetings and then to Switzerland and now sort of going back to Ukraine. And the question is, again, where does all of this sort of land? And really the golden sort of prize for Ukraine out of all of this week and the last really kind of couple of months was to get that agreement for the $50 billion on Russian assets. And he got that, right? He got that from the G7. They haven't worked out the details, but if they're able to, and really at this point they've kind of hemmed themselves in, they need to get this sort of worked out technically, he will have that $50 billion. But, given the Swiss summit and what we saw from the G7, the diplomatic path towards peace seems as difficult as ever. The Venn diagram between Putin's demands and Ukraine's demands, there is zero overlap right there, right? So this is the sort of thing that we need to pay attention to, particularly with a shifting political climate. I mean, we heard from, the candidate in the United States, former President Trump, basically saying that Zelensky left 4 days ago with $60 billion and he gets home and he announces he needs another $60 billion. It never ends. So this is sort of the conversation going in as we head to that election in the United States.
Oliver Crook in Berlin. Thank you very much indeed. There's plenty more coming up. Stay with us. This is Bloomberg. South Korea says the sharing of any nuclear technology between Russia and North Korea is its red line. Vladimir Putin is set to make his first trip to North Korea in 24 years. This week, South Korea's defense minister spoke exclusively to Bloomberg about what he thinks the Russian president will get from Pyongyang.
푸틴이 원하는 건 포탄이겠죠. 미사일하고.
What Putin wants would be artillery shells and missiles. Putin is expected to seek closer security cooperation with North Korea, especially military supplies, such as artillery shells that are necessary to seize a chance to win.
물품에 대해서 북한에게 요청하리라고 봅니다.
In terms of the satellite, we saw North Korea's last satellite launch fail, and that's despite Russia's pledge for cooperation, space cooperation. So what's your take on that?
그게 바로 러시아의 엔진 최신의
They are exactly Russia's latest engine technologies. So our assessment is that North Korea has admitted to receiving engine technologies from Russia. In terms of why they failed, they have yet to secure reliability as they integrate North Korean engines and other technologies that they have developed with Russian technologies. North Korea is believed to be continuing engine tests at the moment, and we believe that they will try another launch in the second half.
할 것으로 쉬운 발사가 아닌 발사를 할 것으로 저희들이 생각하고 있습니다.
How much North Korea is spending on launching these missiles from short range to intermediate range and ICBM? Do you have a breakdown?
Rather than speaking of the cost of individual missiles, let me give you an overall figure. North Korea fired around 30 missiles last year. According to a thorough estimate from the Korean Institute for Defense Analysis, known as KEDA, we would need some $1 billion in spending. The money is enough to cover North Korea's food shortages for a year. So in fact, North Korea is ignoring its people's hardships to carry out missile provocations.
So, Minister, Russia helping North Korea's military technology, that inevitably means greater threat for South Korea. So what is your red line in terms of Moscow's military cooperation with North Korea?
아까 말씀한
We consider the transfer of key technologies related to nuclear and missile programs as the red line, but it's something that needs to be decided together by South Korea and the US. There's no point in the South Korean government setting it alone. So we are having discussions to decide with the US and share with like-minded countries.
We're hearing that there could be another three-way summit between South Korea, US, and Japan. So in terms of the security cooperation, what is the priority for South Korea?
우선 북핵 미사일 위협에 대응하는 데 있어서
A priority would be to establish a system to more effectively, promptly, and coherently respond to North Korea's nuclear and missile threats among South Korea, the US, and Japan, and to make that irreversible. So during the last Shangri-La dialogue, we have decided to create a security cooperation framework amongst the three of us. South Korea has drafted a document and proposed to the US and Japan. The defense ministers of the three countries will sign it in the second half of this year.
한미일 국방부장에 서명하기로 했습니다.
Minister, China has accused the US of trying to build what it calls an Asian version of NATO. So what are your thoughts on that?
중국이
On China's concerns, I think it really depends on China's behavior. If all the countries in the Indo-Pacific, not just China, adhere to the rules-based world order, the rest of the world will not try to limit it. So the idea of an Asian version of NATO to me seems like a premature concern. But at the same time, I believe that the best way to dispel such concern is for China to give the Indo-Pacific region and the international community confidence that it will uphold the rules-based international order, and there should be no problem.
지킨다고 하는 확실한 믿음과 신뢰를 인태지역 나아가서 국제사회에 준다면
South Korean Defense Minister Shin Won-sik speaking exclusively with Bloomberg. Now, in other news, former South African President Jacob Zuma's political party is to end its boycott of Parliament and take up the seats it won in last month's election. The MKP's 58 lawmakers didn't attend the first session of Parliament last week, at which President Cyril Ramaphosa was re-elected for another term. Zuma's party is challenging the result and has filed allegations of rigging with South Africa's electoral court. Coming up, the UK's leader of the Liberal Democrats tells Bloomberg his party will push for closer ties with the European Union. More from the election campaign trail next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Markets caution as traders in Europe eye rate decisions from the Bank of England, the SNB and Norges Bank. Political uncertainty in France weighing on sentiment with Macron pressured on both the right and left. Mixed China activity data shows a pickup in retail spending, but factory output cools and new home prices drop the most in almost a decade. The PBOC keeps rates unchanged. Plus, Ukraine's bid to garner support from the global south hits a wall at its summit in Switzerland, failing to win over India, Brazil or South Africa. Let's check in on these markets. You had that divergent picture across the equity space of last week in terms of Europe versus the US, with losses of over 2% for European stocks versus gains of around 1.4% for the S&P. Futures currently pointed to modest gains in the European session, pointing up by 0.4%. The FTSE 100 looking to add 31 points, and that's despite some pressure coming through on the commodities space. S&P futures currently flat, NASDAQ futures pointing to gains of around 17 points. Let's flip the board and look at the US 10-year, followed by euro dollar. You did see a bond rally last week, part of that down to some slightly softer data out of the US. You're currently at around 424. Yields up 2 basis points so far in the session. A little bit of selling coming through for the benchmark US 10 years so far in the session. Euro dollar, after falling the most in a week for about 2 months last week on the political risk out of France, currently at 107. Brent at $82 a barrel, down 0.4%. And iron ore taking a hit on weaker property data out of China, once again down 2.5%. Let's go back to the France story then, where far-right leader Marine Le Pen says she will not try to push out President Emmanuel Macron if she wins the country's snap parliamentary election, and her party, of course. Let's get more in terms of the details, the consequences, and bring in Bloomberg's Stephen Carroll. Stephen, what do you make? How significant are the comments to Le Figaro newspaper, I believe, from Marine Le Pen?
Well, look, it's interesting because she's clearly trying to appeal to not only centrist voters, but also to try and perhaps calm some of those fears we've seen on the markets as well. She said in response to that question, would you call for Emmanuel Macron to resign if you won the parliamentary elections? She said no, she will respect institutions. She won't call for, in her words, institutional chaos, and that there will simply, in her words, be cohabitation, this word that covers a situation where you have a president from one party and a prime minister from another party. The last time that's happened in France was in 1997. So it's part of the pitch that Marine Le Pen is now making, given her strength in those polls as well, looking at the idea of what she would do if they did come in first, as the polls are currently projecting. She said that she'll lead her parliamentary group in Parliament, but it will be Jordan Bardella who would be the Prime Minister if they come out on top in those elections as well. I mean, in a cohabitation situation, what she's referring to, you have the President taking the lead on foreign affairs and defence. Traditionally, the Prime Minister then takes the lead on fiscal matters. We don't have the full economic programme from the National Rally Party in France. We know they want to do things like cut the VAT rate on energy, cut the VAT rate on certain food products to zero as well. That's something that, according to the Finance Ministry, would cost in and around 20 billion euros. So that's a matter of concern for markets. On that point, Marine Le Pen says the financial markets don't understand their economic programme because they simply haven't seen it. When they do see it, they will. On the other hand, something that Marine Le Pen will be watching closely as well, there were massive protests in France over the weekend, tens of thousands of people marching against some of the policies espoused by Le Pen's party. Yeah, and a reminder of the polarisation across France on this issue. So that's a potential political format that could come about, the cohabitation between Marine Le Pen's National Rally and, of course, Macron's Renaissance could potentially. But on the polling, we've seen the threat from the left as well to Macron. How is what is the detail there? How is his party adjusting to the threats from both left and right? This is interesting because what we've gotten is this alliance of left-wing parties signing up what they're calling the Popular Front. It's bringing together both the far-left party of Jean-Luc Mélenchon, but also the Socialist Party, of course, which had been in power before. And in fact, former Socialist President François Hollande said he's going to stand in these elections as well. So this is pulling together what is already quite a fragile alliance on the left, but they're polling well. They're polling second, in fact, ahead of Emmanuel Macron's party. So that's an interesting other proposition, because when you think about the two-round electoral system in France, you could end up in a situation where Macron's party isn't in the second round in some constituencies. It could be a choice for voters of the far right or of this left-wing alliance as well. Now, some of the policies on that left-wing alliance already may cause ructions for markets because they want to do things like fix the price of essential goods. They're issues that, could potentially cost a huge amount of money at a time when France's public finances are already in focus. We had Macron's finance minister, Bruno Le Maire, out over the weekend also talking about this, saying that there's a threat from the left and from the right, saying that both would make France poorer, make French people poorer in their pockets as well. He says that victory is still possible. Looking at the polls, though, it looks like a fairly uphill battle. Of course, though, still plenty of campaigning to go between now and the first round of voting on the 30th of June. Yeah, in about 3 weeks' time. Stephen Carroll with a fantastic breakdown of how the political landscape continues to adjust in France. Thank you. To the UK.
and the politics here with the run-up to the election, of course, on July the 4th. The leader of Britain's Liberal Democrats has set out a path to rejoin the European Union's single market, saying businesses need closer ties to prosper. Ed Davey told Bloomberg the Conservative government was to blame for poor relations with the bloc.
We're the only party talking positively about engaging with our European friends and neighbours. We're talking about rebuilding that trust and relationships that have been so poisoned by the Conservatives. You know, when I talk to businesses, they say we're not investing in the UK because there's no long-term strategy, there's no real link up with Europe, and people are taking their money elsewhere. And I think that's really sad. And under the Liberal Democrats, you'd get a long-term, stable policy. And we're so committed to that stability, so we could tackle these issues about the problems with regulators, get better trade deals. That's the sort of climate that would attract investment. You know, when we were, for example, in government and running the energy sector, we saw tens of billions of pounds invested in the UK because of Liberal Democrat policies. We introduced contracts for difference, which were transformative in improving our electricity system and making it go low carbon. And that system of financial instrument was copied the world over. So I'm really proud of our record, I'm proud of our policies, and I'm particularly excited because in places like this, maybe a bit windy and a bit blowy and a bit rainy today, but the sun is shining on the Liberal Democrats.
I'm just waiting for the thunder to start, just to add to that chorus that you're speaking about. So basically, I can say with a degree of certainty, after having heard what you just said, that a vote for the Liberal Democrats is a vote to rejoin the single market. Is that pushing it too far, or is that fair to say?
Well, what we are saying is that we're realistic about the time scale for that. It can't be done overnight.
Yep.
We've got to rebuild that relationship with our European colleagues. When I've spoken to European politicians like Christian Lindner, the finance minister of Germany, he says, look, there is a trade on the table. It falls a bit short of the single market initially because I'm afraid European friends don't quite trust the UK any longer. And who can blame them, given the way the Conservatives have broken the rule of law and treated our European neighbours? So we've got to build that friendship back. You can do that with a good trade deal to start with, and gradually over time we have a four-phase process that could get us back into the single market, but it may take a while.
And that was UK Liberal Democrat Party leader Ed Davey speaking with Bloomberg's Guy Johnson. Of course, the date for the UK election, July the 4th, and we keep across, of course, all the build-up to that. Now, a run of key central bank decisions this week should shed light on who is joining the global interest rate cutting cycle and indeed who is not, who's still sitting on the sidelines. With a looming, of course, UK general election, the Bank of England looks likely to hold rates steady when it meets on Thursday. Let's bring in Bloomberg M-Live strategist Ven Ram. Joins us from Dubai. Ven, June may turn out to be kind of a widespread display of hesitancy then, if you put the Central Bank of Canada to one side, for example. When it comes to the BOE, is the constraint the data on inflation or is the constraint the politics?
I think it's a bit of both because we are in the run-up to the elections. The BOE is widely expected to stand pat, which is not a major surprise. But looking beyond the elections, what is in store for the BOE? Now, the BOE wants to cut rates. It wants to take rates to less restrictive levels. But the point is, if you look at core inflation and services inflation in the UK, Tom, they are kind of well above the Bank of England's target. Services inflation is still holding around 6%. Core inflation is just a whisker short of 4%. That means that the real policy rate that the BOE has at 5.25 isn't really all that restrictive as they would imagine. So I think that, the markets are thinking that 2 rate cuts are probable this year from the Bank of England. I do think that if at all they get to cut rates, I think 1 will be what is more likely.
OK, 1 is more likely, but 2, according to the markets, the market view, 2 is still possible from this Bank of England, which, of course, comes through with its decision on Thursday. To the political risk out of France, then, Vem, what is your assessment as to whether or not the markets have overpriced or underpriced the risk in France?
I think the markets are rightly pricing the risk in France at the moment. I don't think it's overpriced. I don't think it's underpriced yet. I think it's 75 basis points. If you look at these spread over German 10-year securities, 75 basis points is the wides that we saw in the run-up to the French presidential election back in 2017. So they're kind of reasonably priced. If you look at the 10-year bond, my model says that that is undervalued by about 20 basis points. But that undervaluation reflects a premium that investors want to hold French securities rather than German securities at this point. Of course, Marine Le Pen of the National Rally reached out to investors on the weekend saying that, look, investors needn't fear. National Rally, our policy isn't going to be market disruptive. So we have heard some conciliatory remarks from her over the weekend. That means that, French securities may kind of tread water around here, but there is still a big risk going into the June 30th and July 7th elections. So I do think that investors are going to be jittery around here. They will want to hold French securities around current levels. So there's not going to be a major selling at this point because of her remarks over the weekend. But I do think that there is no incentive for investors to be buying them, especially if you consider what the S&P did just at the start of the month. They cut France's debt rating. That means that French securities are now AA- rating, and S&P expects that France's fiscal deficit will widen much more. They expect GDP debt to reach 112% of GDP in 3 years' time. That's kind of alarming. And if Marine Le Pen's party says that they are going to cut sales tax and what have you, that is going to put more pressure on the fiscal front. So all that is not great news for French investors.
OK, Bloomberg MLive strategist Ven Ram on the alarming nature of the balance sheet of France and, of course, the preview of the Bank of England decision for later this week. Ven Ram, thank you very much indeed from our MLive team. Coming up, we're going to take a look at what the mixed data out of China reveals about the recovery of the world's second biggest economy. Just how fragile is that recovery? That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Monday. Let's go to China now, where the PBOC has left a key interest rate unchanged. This as data today showing that new home prices dropped the most in almost a decade in the most recent month. That's despite government efforts, of course, to support the property market. Retail sales came in slightly stronger than estimates. Industrial production came in slightly weaker than the estimates. Let's talk to Bixuan Xu now, Global Equity Fund Manager at Royal London Asset Management, for the take and how to position potentially in the Chinese markets if you have appetite. Bixuan, thanks for joining us in the studio.
Morning.
Let's start on the economic data then out of China. We've been talking about the fact it's a mixed picture. We have a reminder that the housing sector and the crisis around the property sector continues apace despite the efforts of the PBOC and the Ministry of Finance to try and support that sector. How fragile is the recovery in China right now?
So the picture shows that the recovery remains fragile, but not forget the major stimulus policy came in mid-May, so it is probably too early to see those measures to take impact, and they were the right steps into the right direction, whether it was real estate or the fiscal stimulus. So we just need to wait and see for this policy to take place. Clearly, there is no turning point or there's no tipping point we were looking for that hasn't happened in May. What we are looking for is really the kind of more steady consumption recovery, and that depends on two factors. If we just think where consumers are in China today, so their balance sheet is impaired, so that the property equity is probably negative, and their wage growth was also impacted because China was the last one to come out of the lockdown. So the first thing we need to see is the stabilization of property market. As you were right, the property price needs to tick up again, and we need to see a steady trend. So for the balance sheet to be repaired. And then secondly, we also need to see more fiscal stimulus that go actually into the private companies, private economy, so the wage growth comes as well. So they feel confident that there will be income growth in the future, and the income growth is growing on the wage side. So before these two things happen, the consumption pattern will remain quite patchy.
OK, something I zero in on then, in terms of your answer, is the question of when, the timing. You say when things kick in. What is your best estimate of when that pivot and when that moment comes to the fore? You say that the policy response so far has been constructive. It has been the correct mix. When do you start to see that really showing up in the data?
So the exact timing is hard to say, but then we have a sequence of events we want to watch for. So the first one is the property market stabilization, so the month-on-month price. And the second thing is really the PPI, the industrial profit, needs to improve. And not only in the upstream, as we see today, it's across the board. So only when the companies are actually making a profit, there will be real wage growth. So these are the two factors that need to happen in this sequence. Then we know, OK, the kind of steady consumption recovery is on the way. If the consumer data improves, we know it is going to stay. So exactly, it's hard to predict because it depends a lot on how the fiscal policy will be implemented and how effective the local government and the banks will be to support the private economy, to get them out of that negative equity as well.
On corporate earnings and the earnings story, you talk about structural trends that you need to be thinking about in China to get a gauge as to the health or the direction, I should say, of China's corporate earnings. What are those key trends? What are you watching?
So there are mainly two things. One big thing is geopolitics. So if we look at the Chinese economic growth in the past 30 to 40 years, that has been the story of participating in the global supply chain and moving up in the value chain. And the big question now is China is very willing to continue to participate in the global trade and moving up this value chain. But is the rest of the country going to allow China to do that? And the other component is China going to be able to access to chips, for example, because AI and all this innovation in tech are going to be a huge important factor to drive up productivity. Is China is blocked or excluded from this, then the productivity improvement in the economy is becoming increasingly very harder for China. So this is a huge question, and this is really, really important.
OK. Just before we let you go, Bixuan, and just briefly, if I may, what would you be adding at this point in China?
Surprisingly, one of the sectors that we find interesting in Royal London, so our approach is we invest across the corporate life cycle from turnaround to accelerating, and we try to identify long-term mispriced cash flow. One of the interesting sectors from China is actually appliance. So first of all, capital cycle is a very important element in our process and particularly important for China. There is always boom and the bust of capital cycle, and home appliance actually is a sector where the hot money and capital have left decades ago, like probably 10 years ago.
Okay.
And then secondly, the profit is very stable, and they have gone abroad, like expanded overseas before the geopolitics happened. So they have a very diversified earnings stream. And thirdly, people think they are very correlated to the real estate sector, but actually they're not. Their demand is mainly driven by the upgrade and premiumization. Okay. So there is an interesting valuation angle.
OK, maybe look at dishwashers and washing machines in China and the makers of those white goods. Bixuan Xu, thank you very much indeed. Global Equity Fund Manager at Royal London Asset Management, on the data out of China and maybe how to position as well, with the risks, of course, in focus in terms of geopolitics and supply chains. Here's what else to be thinking about then through this week. On Wednesday, we're going to get inflation data out of the UK, CPI data out of the UK, of course, on the same week when we get that decision from the Bank of England, so that will be consequential. On Thursday, it is that BOE decision, and markets expecting potentially the first cut to come through in September, potentially August, September, looking past and through those elections. Thursday, you're going to get the decisions from the SNB and the Norges Bank, of course, over in Norway as well. So again, a reminder that it's a big week in terms of central bank decisions. There's plenty more coming up. Stay with us. This is Bloomberg.
monetary policy right now is well positioned, really, to ensure that inflation does move back down towards 2% over time, and that labor market conditions remain healthy. And that's a good position to be in.
Outgoing Cleveland Fed President Loretta Mester speaking to Bloomberg's Michael McKee on her expectation, her take that we can sit comfortably at rates of between 5.25 and 5.5% at the Fed for a little longer until that data confirms that they are more sustainably on that 2% track. And it is the higher interest rate regime in the US, and particularly versus the Chinese rate of around 1.5% on the 1 year. And look at that gap that is leading to the fund flow story really adjusting markedly. We have a Bloomberg piece out, drawing on data from the IMF out today, talking about the fact that about a third of global funds are moving and have moved to the US since the pandemic. The US is once again preeminent in terms of the fund flow story, and a big reason for that, certainly in terms of the funds moving from China to the US, is of course the rate differential story. But also don't forget the subsidies in place from the CHIPS Act, the Inflation Reduction Act of Joe Biden, President Joe Biden, of course, drawing those fund flows back in. Just a reminder that the dollar supremacy, of course, particularly on the element of that story, remains consequential. But that's the yield gap, that's the rate gap between China and the US, and that is a big part of that story. Let's flip the board and have a look at the home price story in China as well, because the two, of course, are linked. The reason that PBOC and the Finance Ministry can't do more in terms of lowering rates is, of course, part of it, at least, down to the fact that Fed rates remain very high. They're worried about outflows, further outflows. And just a reminder, the pressure on the real estate sector of China just continuing at pace. New home sales, prices for new homes falling the most since October of 2014. Prices down now for the 12th straight month on month. And that's despite the package of support that came through from the government in the last month. Let's flip the board and turn our attention back to the political risk of France, because this poll just tells you everything you need to know, at least now, in terms of the pressures on President Macron. That's his party squeezed both on the right and the left. As we look, of course, at the outflows from French markets, that is a story that will continue to dominate for us. Markets Today is next. This is Bloomberg.